Airbnb reported earnings last week and the stock's been selling off. What's going on? This video is Airbnb analysis. I'm going to give you the earnings highlights. I'm going to show you some of the pros and the cons, short-term headwinds, long-term tailwinds. We're going to look at valuation and we're going to look at a chart. And I'm going to tell you if I think Airbnb stock is a buy or not at these levels. Let's get started. So you can see over the past month, it's down about 9.26%. It's trading right now at $105.41. Now this was $127 on May 9th. $67 billion market cap. The PE ratio right now is about a 35. The 52-week high, $144.63. It got down to $81.91. And that wasn't that long ago. Just in December of 2022, Airbnb was in the 80s, the low 80s. So is the stock a buy or not? Let's dig in. So first earnings, May 9th, Airbnb Q1 GAAP EPS 18 cents, beat by 8 cents. Revenue of $1.82 billion. That was up 20.5% year over year. That beat by $30 million. Looks good so far. So what's going on? Airbnb says first GAAP profitable Q1 with $117 million in net income. That's a $136 million improvement from Q1 2022. Gross booking value, $20.4 billion. That's up 19% year over year. Nights and experience booked, that was up 19% year over year. Free cash flow, impressive number here, $1.6 billion. That's up 32% year over year. So again, these numbers are very positive. So why is the stock selling off? It really comes down to guidance. So Outlook sees Q2 revenue of $2.35 billion to $2.45 billion versus consensus of $2.42 billion. Of course, if they come in at $2.45 billion, they're going to beat consensus, but that low end is $2.35 billion. Airbnb expects year-over-year growth in nights and experiences booked in Q2 to be lower than its revenue growth during this quarter. So they're seeing a slowdown potentially. Airbnb also anticipates a slightly lower ADR in Q2 2023 versus a year prior. So the market's looking at this outlook and it sees it as disappointing. Now you also have to remember the stock was just in the 80s not that long ago. But they're telling us here there's probably going to be more pressure on margins. So that would suggest that landlords would potentially lower prices. And that happens when demand is going to be lower. So you'll probably see less travel. People that do travel will stay less nights. Landlords will lower prices and you could see a bad quarter or two. So in a nutshell, the macro is not supporting the valuation and the growth, and they're taking a little bit of a pause and selling the stock off. Inflation and really uncertainty over the economic situation might cause people to travel less often. Now we've seen strong demand in travel. People are still trying to catch up from the pandemic, but this is suggesting that it could start slowing down a bit. Now I have some thoughts on this and I'll share more about the possibilities later in the video, so definitely keep watching. So the headline here is Airbnb falls sharply with signs the travel demand boom may have peaked. This is the fear. And of course, analysts are going to have different opinions about what's going on here. Evercore called the outlook and resulting share price reaction a bit of a course correction. He noted that fundamental trends have modestly softened with 24% year over year FX revenue growth, marking a 7-point deceleration versus Q4. An EBITDA margin of 14%, 100 basis points year over year decline. Mizuho Securities analyst says that ADR growth remains sticky, but signs of price sensitivity is showing up. The firm kept a neutral rating on Airbnb due to what it sees as a premium valuation over other travel peers. If you look at the peers, that's not necessarily the case at these price levels. For example, Expedia is trading at a PE ratio of 47.28. Again, Airbnb at 35, and the forward PE is even lower. And Booking Holdings is trading around a 26 PE, so it is a little bit lower. Morgan Stanley said lower than expected forward room night growth speaks to how forward growth, which is more reliant on Europe, APAC, and Latin America, and new business opportunities could face higher execution risk. At the same time, this is a massive tailwind longer term for Airbnb. Lots of room for growth in these areas. And here's the shareholder letter. You can see $1.8 billion of revenue, 20% year over year. Net income, $117 million. Adjusted EBITDA, $262 million. That free cash flow, again, $1.6 billion. That's up 32% year over year. Gross booking value, $20.4 billion, up 19% year over year. And we said earlier, two nights and experience booked, up 19% at $121.1 million. Now, I don't have time to go into a lot of detail sale, but do know that there are a lot of improvements that are coming for Airbnb when you think of the app. They essentially took feedback from customers and from hosts from thousands of interactions, and they're trying to make improvements. They want to make hosting mainstream, perfect the core service, expand beyond the core, and more. So more guests are traveling on Airbnb than ever before. We know that nights and experiences booked grew 19%. So even with macroeconomic uncertainty, they've seen their highest number of active bookers. And that demonstrates both loyalty from returning guests and a growing base of first-time bookers. And their current backlog of nights is approximately 25% stronger than a year ago. So there are a lot of positives here. Guests are traveling overseas and returning to cities. Guests are continuing to use Airbnb for longer stays, like staycations or even work from remote places. Supply growth continued to accelerate. And this is a quick snapshot of that 2023 summer release. So they're making the most extensive set of improvements ever for their service based on feedback from the community. They took a design-driven approach, created a blueprint for the entire experience, including 150 screens across our app and website, 72 user policies, and every interaction with customer service. So they analyzed millions of customer service calls, thousands of social media posts, and spoke to guests and hosts all over the world. So total price display, new pricing tools for hosts, transparent checkout instructions. A lot of people complain that the pricing wasn't transparent. They're trying to improve that. More affordable monthly stays for those longer vacations and staycations and working remotely. Priority customer service on a trip. Pay over time. So they're going to partnership with Klarna to be able to basically buy now, pay later, and pay over time. So let's talk about some additional pros. We'll look at some cons. We'll talk about valuation a little bit more, and then we'll look at a chart. Now, before I go on, I need to announce that this video is sponsored by The Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. You can also join our private community by visiting patreon.com/firedupwealth for both Patreon and Discord. So what are some tailwinds longer term if you're thinking a long-term investor holding this stock for 5 years? The first that comes to mind for me is emerging markets, growing internationally. There's lots of opportunity there. A lot of Airbnb's presence is more in Western countries right now, and there's tons of opportunity for growth. And to kind of piggyback off that, Airbnb has a tremendous opportunity to grow its market share when you think about other competitors. When you think about Airbnb, it's like Kleenex. You know, if you want a tissue, you say, I want a Kleenex. If you're going to book, even if you use Vrbo, you're going to say, I'm going to go use an Airbnb. I'm going to book an Airbnb. And you might actually look at Vrbo and Airbnb, but you're going to use it as a verb, right? I'm going to Airbnb a property. So it definitely has market share. It really has that first mover advantage. And I think with younger generation, the name brand is very sticky, especially when you think of the experiences that they're adding on to just stays. Now, Airbnb is also profitable and they're buying back more and more shares. So this is from the earnings call transcript. Because of our strong balance sheet, we were able to repurchase $2 billion of our stock in the last 9 months. And today, we're pleased to announce that our board just approved a new repurchase authorization for up to $2.5 billion of our Class A common stock. And that's somewhere around 5% or so of current market cap, so it is significant. And I mentioned earlier about competitors and market share. You can see Airbnb has about 26%, Booking about 34.57%. Vrbo only has 5.26%. You might be surprised by that, and you can see on your screen the other competitors there. It would actually concern me more if Airbnb had, say, 50% of this pie, because then I feel like there's more risk that they lose to competition. They lose market share. But being at 26%, I actually think they can grow this. I mean, Expedia is only 7.31%. And of course, when you think of Expedia and Booking Holdings, they're huge conglomerates that own different pieces of this pie as well. When you think of the younger guests, so age group, 18 to 24 is 15%. The biggest is going to be 25 to 34 years old, 36%. And that makes sense. When you're 18 to 24, you probably don't have a ton of disposable income for travel. In 25 to 34, you're going to see more people that maybe don't have children and things like that. It makes more sense. That's when I traveled a lot in my 30s, 36%. But even 35 to 44 is 23%, 45 to 54, 14%, and so on that you can see on your screen. So we talked about some of those risks earlier. For example, a recession. Maybe the travel boom is slowing down. People got it out of their systems, and you could see, a slowdown in travel over the next several quarters. But also share dilution and insider selling. And the problem with this is they're diluting, so you can see the stock-based compensation is at a 45-degree angle. And shares outstanding outstanding did dip, but now it's starting to level back up a little bit. But essentially, there's a ton of stock-based compensation. That's an issue for a lot of these growth stocks, and that's causing dilution. And they're not buying back enough shares to completely balance it out. And here you can see massive insider selling. So anytime there's a new IPO, a lot of these people might have gotten shares as part of their compensation package. And they're going to start selling some of these shares. You can see they were selling, it makes sense here. Some of these are selling at $125 and so on, $140, $130, $134.67, but some are at $113, $111, and so on. So that suggests that when it gets to, $130 range in that price range, that some people think that it's okay to sell there, that it might be getting a little bit expensive, maybe a little bit ahead of itself. And you have to take this with a grain of salt, but when there's this many sales, it is something to at least pay attention to. It's not the sole reason to buy or sell a stock, but it's something to analyze when you're looking through a stock, whether you're going to buy it or not. Okay, so we went through some pros and cons. That share dilution is something to pay attention to. That slowdown is something to pay attention to. From the valuation perspective, right now it's a 35.25 PE ratio. It has about 5.19% short interest. And Airbnb has solid growth and they have profitability, but the data is showing that that might slow down. And of course, Wall Street's not going to pay as much of a premium. But if you look at this, enterprise value, May 15th, $57.3 billion. Price to sales, 7.69. Not cheap from that perspective, but you want to look at other metrics as well. Price to book, 12.6. Also not great. But PEG ratio, you want to see this 1 or less. It's about 1.87. Now, some of the higher quality companies, most of the higher quality companies that people want to pay a premium for future growth, you're going to see higher than a 1 PEG ratio. Oftentimes even 2 or even higher than that. 1.87 is not dirt cheap, but it's not bad either. And then when you look at the PE for this year's estimate, 30.8, and next year, 26.3. So this suggests to me that as a long-term investor, this stock could grow in the valuation and be a decent growth stock for long-term investors, people that have that long-term horizon in mind. So in the short term, there's fears about slowdown, about recession, and so on. But long-term, we talked about some of those tailwinds that could boost this company over time, especially when you think 5 years or more. Of course, one of the risks is always going to be competition. Now, they seem like they're always staying ahead of the pack, trying to innovate, trying to make changes and improvements, and that's what you want to continue to see as an investor. Now, one thing that I want to talk about here is I think it's possible too that Airbnb could potentially be sandbagging just because they don't know. So they'd rather be conservative with their guidance and give that range they gave us versus being overconfident, because Wall Street hates that. If you have a number that's high and miss it, you're going to get whacked. So they might be setting the bar low, and there's a possibility they actually come on the high side of that guidance and beat consensus. So let's look at a chart and see, should we be buying at $105 or is this stock going to go lower? Now, every single Wednesday in Patreon Discord, we do chart day. So when you see orange, that's a previous chart day. Yellow is today's chart day. I don't have anything written up in yellow for today. I'm just going to talk through it with you. If you want to join us every single Wednesday for chart day, visit patreon.com/firedupwealth and join elite or higher. You can see last time we talked about this stock and said earnings double beat, but lowering expectations next quarter. Is that sandbagging? We don't know for sure, right? But the market, it ran the stock up. You can see it ran it from $81 up to $144, had a huge run. It's giving it back. Now, a lot of times you'll see consolidation. You have a 50% retracement. So you take that bottom to the top when you have an aggressive run like this and basically cut 50% of it. And sometimes it overshoots as well. So this is actually pretty healthy because it's unhealthy to go from 81 to 144 that quickly. And you're going to see some consolidation, especially if there's a macro event. And in this case, there was with earnings, right? Lowered guidance, lowered outlook. So we shared some possibilities and we said that it's possible you could see buyers around 110. And that did happen at first, the first couple of days, and then it broke down. And in fact, it got down to $103 and change at the lowest point here recently. So possibilities, this again was before it broke down this far. We said 104.60, 101. You can see on your screen all the way down to $85 as a possibility. It doesn't mean it has to happen. It's just possible on the chart. Now these colors here represent a Fibonacci retracement. And so you can see the bottom of this line here is about $95, and that's certainly possible. These are Fibonacci's, and you have your resistance and supports. This S3 is around $101. So is Airbnb a stock to buy now? I like this stock, $105 or less, dollar cost average. I prefer it below $100. And if it did get in the 80s, even 85 to 89, I think it's a strong area to add. Of course, any stock has risks. I'm not a financial advisor and you have to do what's best for your money. But what I'm seeing on the charts, what I'm seeing from this company for long-term tailwinds, I think you'll be happy if you dollar cost average this stock 104 105 or less. I wouldn't go all in at $105 personally, but again, that's up to you. If this video is helpful, make sure you like, comment. If you're new to the channel, subscribe, click that bell to get notifications. Appreciate your time and attention. Have a great rest of your day. Take care.